If a crypto app offers 20% yield, the first question is not, how do I get it? The first question is, who is paying me and why? This video is about DeFi yield, not as magic internet interest, but as a money flow. Every return has a source, and every source has a risk attached. Beginners often see yield like a faucet. Deposit tokens, wait, collect more tokens. But DeFi is closer to a marketplace. You earn because somebody else needs liquidity, makes a trade, pays interest, or wants users. Here is the simple rule that explains almost everything. Yield must come from someone paying for a service, or from you accepting a risk that someone else wants to avoid. In a normal bank account, the bank may lend your deposits and pay you part of what borrowers pay. DeFi can do something similar, but with smart contracts instead of a branch manager. The strange part is that in DeFi, many of these flows can be seen on-chain. You can often inspect deposits, borrows, fees, and incentives. The danger is that visible does not always mean simple. The easiest yield to understand is lending interest. You deposit a token into a lending pool. Borrowers take tokens from that pool, and they pay interest for using them. Someone might borrow because they want leverage, short exposure, working capital, or temporary liquidity without selling another asset. The interest they pay becomes the raw material for lender yield. Most DeFi loans are over-collateralized. That means the borrower usually locks more value than they borrow. The protocol is not trusting their identity. It is relying on collateral and automatic rules. Lending rates move because demand moves. If almost nobody is borrowing from a pool, the yield is usually low. If most of the pool is borrowed, rates can rise to attract more supply and slow new borrowing. That rate is not a promise for the entire year. It is a current condition. If borrowers repay, if more lenders arrive, or if demand disappears, the number can change quickly. Lending yield sounds clean, but it still has risk. Bad collateral settings, oracle failures, smart contract bugs, or extreme market moves can turn a simple lending pool into something dangerous. The second big source is trading fees. On a decentralized exchange, people trade against liquidity pools. If you provide the assets in that pool, traders pay small fees that can become your yield. Imagine a market stall that always has apples and oranges. Traders can swap one for the other. As the stall owner, you earn a small fee each time someone trades. When you add liquidity, the protocol gives you a claim on part of the pool. That claim represents your share of the assets and your share of the fees. Trading fee yield depends on how much trading happens, compared with how much liquidity is competing for those fees. A busy pool with little liquidity can show high fees. A quiet pool with lots of liquidity may not. If this kind of money flow explanation helps, consider subscribing. We focus on the mechanisms behind crypto and AI, so the numbers on screen make more sense before you take them seriously. Liquidity pool fees are not free money because you are not just holding tokens. You are letting the pool automatically rebalance your position as prices move. This is where impermanent loss appears. If one token rises a lot compared with the other, the pool sells some of the rising token into the trade. You may end up with less than if you simply held both tokens. The word impermanent can be confusing. The loss is only impermanent if prices return before you withdraw. If you exit after the price has moved, the effect becomes very real. Being a liquidity provider is a competition between fees earned and price movement cost. Sometimes fees win. Sometimes impermanent loss wins. The APY often shows the pleasant side more clearly than the painful side. Pools between similar stablecoins usually have less price divergence than pools between volatile assets. That can make the yield feel calmer, but it does not remove risk completely. A stablecoin can lose its peg, rely on reserves, depend on mechanisms, or face smart contract and regulatory risks. Stable yield is not the same thing as risk-free yield. Yield paid in a volatile token is different from yield paid in the same asset you deposited. You might earn many tokens, but if those tokens fall in price, the dollar value can shrink. The third source of DeFi yield is token incentives. A protocol may print or distribute its own token to attract users, lenders, or liquidity providers. This can be useful in the early stage of a market. The protocol wants liquidity, traders want deep pools, and rewards can help start the network effect. But incentive yield is often a subsidy. It may not come from real user demand. It may come from a reward budget that can be reduced, diluted, or exhausted. People sometimes call yield real when it mostly comes from actual fees or borrower payments. They call it subsidy-driven when the attractive number depends heavily on newly distributed tokens. Subsidies are not automatically evil. A new business can spend money to attract customers. The key question is whether useful activity remains when the rewards slow down. If users arrive only for rewards, they may leave as soon as another protocol pays more. When liquidity leaves, trading gets worse, borrowing rates can change, and remaining users face more stress. APY is especially slippery because it annualizes a short-term rate. A pool earning a high rate today may be displayed as if that rate continues for a full year. APY also assumes compounding. That means rewards are repeatedly added back into the position. In real life, fees, gas costs, changing prices, and changing rates can make that path very different. APR is usually the simple yearly rate before compounding. APY tries to include compounding. Neither number tells you the full source of the yield or the full risk behind it. Always ask what the yield is measured in. 10% more of a weak reward token is not the same as 10% more dollars, ETH, or stablecoins. Some strategies increase yield by borrowing against deposits and redepositing again. This can magnify returns when conditions are calm, but it also magnifies liquidation risk when prices move. A user might deposit collateral, borrow a stablecoin, supply it somewhere else, and repeat. The dashboard may show a bigger APY, but the position is now connected to multiple moving parts. If collateral value falls too far, the protocol may sell it to repay debt. This protects the lending pool, but it can turn a yield strategy into a sudden loss for the borrower. DeFi protocols are software holding money. If the code has a bug, if an upgrade goes wrong, or if an integration breaks, the yield does not matter much compared with losing principal. Many protocols need price feeds to know collateral values. If a price feed is delayed, manipulated, or fails during chaos, the protocol can make bad decisions very quickly. Yield may also depend on bridges, wrapped assets, or smaller chains. Each extra layer can add convenience, but it can also add another place where something can break. High yield often attracts liquidity, but fear can remove it. If everyone wants to exit at once, a pool can become thin, slippage can rise, and selling can become expensive. During a market crash, several risks can arrive together. Token prices fall, collateral gets liquidated, borrowers scramble, stablecoin pegs may be tested, and reward tokens can drop hardest. A very high APY can mean strong demand. It can also mean severe risk, temporary rewards, low liquidity, or a token price that is moving against the position. Think of yield like a restaurant discount. A busy restaurant gives coupons to handle growth. An empty restaurant gives huge coupons because nobody is coming. The same number can tell two very different stories. So before caring about the size of the return, trace the money. Are borrowers paying interest? Are traders paying fees? Is the protocol distributing tokens? Or is the position just taking more market risk? First, ask who pays. If the answer is borrowers, look at why they are borrowing and whether the rate comes from real demand or a temporary shortage. Second, ask what you are risking. Is it price volatility, impermanent loss, liquidation, smart contract failure, stablecoin failure, or some combination of all of them? Third, ask what token you are earning. A high reward paid in an unstable token may be worth much less by the time you can sell it. Fourth, ask what happens if the APY falls. If the strategy only makes sense at the current number, it may not survive a normal change in market conditions. Fifth, ask how easy it is to exit. Check whether liquidity is deep, whether withdrawals are instant, and whether the path out depends on other markets staying healthy. You can sort most DeFi yield into 3 buckets: borrower paid yield, trader paid yield, and incentive paid yield. Many strategies are mixtures of these, with extra risk layered on top. Sustainable does not mean safe. It means the return has a repeatable economic reason to exist. Borrowers keep paying because they need capital. Traders keep paying because they need swaps. Subsidies need a budget. Be careful when nobody can explain the source, when the yield is mostly paid in a thinly traded token, when the strategy uses heavy leverage, or when exits depend on constant new deposits. The goal is not to fear every yield opportunity. The goal is to stop treating yield as a gift. In DeFi, return is usually payment for liquidity, payment for risk, or payment for attention. If you remember one thing, remember this: APY is the headline. Money flow is the story. Before entering any protocol, follow the cash, follow the risk, and assume the number can change. What DeFi yield source still feels confusing to you? Lending, liquidity pools, token rewards, stablecoins, or impermanent loss? Ask in the comments and suggest the next crypto concept you want explained simply.